Welcome back to Simply Money. Today, I want to talk to you about something that really bothers me. Recently in the stock market, there was a big drawdown, selling off, the market dropped, and that's normal. It was larger than a normal day to day drop, but it was a normal cycle of the market. Here's the part that bothers me. And maybe it bothers you. We as humans are emotional creatures, and when it comes to money, we become super emotional. We get scared. And if you watch the news, it's full of fear mongering. It's people just always yelling, the sky's falling, the end of the world, the economy's going to collapse. And so, what I want to do today is quickly just show you how to approach this and to get better perspective. Because remember, if you're investing in the stock market, you're not doing it for one day. You're not doing it for 1 week. So we want to look at this. I didn't make a video yesterday when the market dropped really hard, but I was getting infiltrated in my inbox of notifications of other YouTubers who are calling for panic, who are screaming about, oh, the recession's here. I don't know, maybe a recession is coming, but that's not how to approach it. You don't approach it with fear. You don't approach it with this emotional reaction of, this is what the market's doing today. Let's look at this. Here's today's market. I'm going to blow the screen up. So here you can see, this is the S&P 500. We could use the NASDAQ. We could use any of the industries, but we're going to use the S&P 500 as a simple illustration of what I'm talking about. So this is today. Today was okay. We had a little bit of a rise. It went up and then it came back down a little bit. It was a positive day of a 1% gain. I would love 1% daily. That'd be great over the course of the year. That's a great year in. But that's not how it works. Even in the day, you can see some ups and downs, and then even after it peaked, it came down a little bit. That's not what I'm talking about. I want to back up. I wish I had a 2-day view, but I'm going to go to the 5-day view. You can see right here, this here yesterday, as of the making of this video, this here, the market plummeted. And as you can see, just in 5 days, it's dropped 3.61%. Some of the bigger companies that had really taken off this year, like NVIDIA, the Magnificent Seven, Google, Amazon, Apple, those companies had significant drops, but they're much more volatile. Their beta is way above 1. 1 is the standard comparison to the S&P 500. Above 1 means that it fluctuates more than this S&P 500. The S&P 500 had a rough day, had a rough 5 days. You can see that. And we see this right here. This is where people panic and everyone gets, it's time to make a new video and say, oh, the market's crashing. This is what you need to do. You need to sell. You need to get into this fund, whatever the case might be that they're approaching it. Instead of just saying, hey, you're in this for the long term, take a deep breath, step back and look at the big picture. That's why you're in the stock market. You're not in it for day trading. You're not in it for a short, quick, make a buck. This isn't a get rich quick scheme. The stock market is an investment for long term. Long term is years. So relax, step back and take a bird's eye view at the stock market. So let's start doing that. Let's skip back here a little bit. Let's go 3 months. Well, now when we look at that, this little drop isn't quite as significant. Now, over 3 months, we've only seen 2.19% gain from this. It's better than the negative 3.6, but we've gained 2.19%. And you can see that it peaked up here and then dropped. And this is where the panic starts right here, because we're looking at a very narrow, short-term view of the stock market. Relax, be patient, be calm. If you're too emotional, the stock market is going to crush you. Let's step back a little further, get a better view. Well, that's a little better. 6 months, we've gained 6%. Again, you can see some ups and downs. So this little downturn here doesn't look quite as bad now because we see some other downturns and we see that, at its lowest, we're still above where we were 6 months ago. But 6 months isn't why you're in the stock market. Let's go to 1 year. Well, that's looking better. Now we've gained 17%. And this little downturn here is looking a lot smaller than it did on the 1 or 5 day view that we just had. See, this is a downturn. It's a little bit of a sell-off, but it's not panic mode. I actually watched a video of someone saying, this is the next Great Depression. This is going to be 1929. No, it's not. This is a cycle, a news cycle, a political cycle, a world event cycle. These things happen. The news gets people stirred up and they respond emotionally. Now let's look more at an investor's view, 5 years and beyond. Now we're looking at 5 years and we see an 84.2% gain over those 5 years. Look at this. This little downturn doesn't look all that bad now, does it? Look how much further up you are from here. And look at this downturn compared to the pandemic 2020. Look at that downturn. But remember, that was short-lived and it was back up to normal within a few months. It went higher than it had dropped in just a few months. From February 10th to August 24th, we see that it went from its high here, dropped, and then it regained that high and just kept moving up. And we had some downturns. We had 2022 was a rough year, but it was still higher than we had been here. You have to look at the long term. We're going to zoom out to all time here. This is quite a view because it goes way back here to 1928. So you can't even see the Great Depression in there. You can't see hyperinflation of the 70s in here. You can see some of the dot-com bubble. You can see the real estate bubble here. You can see 2022 here. But when you look at long term, look at that. Now, again, you're not going to be investing for 100 years, but it's gained 29,000%. It's going up. And you have these views here that show you that this little downturn is insignificant in the grand scheme of investing. You invest for the long term, you be patient and stick with your plan, and don't let these little blips on the screen force you or lead you into selling off and locking in those losses. Because the only people who lost on this are the people that sold, because you locked in the loss. Now when it recovers, when it comes back to today, when it comes back to this return that we'll see, if you lock in, you miss these returns. Don't lock in the loss. Be patient. That's it for today. Be patient. Be a wise investor. You're in this for the long term. Thank you for joining me on Simply Money. Hit the like and subscribe button and help us get more of these videos out to help others be patient and learn the psychology of investing wisely.